Hello and welcome. Moss Adams is pleased that you joined us for today's session, which is the first of our Private Foundation webcast series, Form 990 PF and PF Excise Taxes. Before we begin, I'm going to play our housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves, and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in your console. And now, I'd like to introduce today's presenters, Maggie Elliott, Senior Manager with Moss Adams, and Marisa Meltebeke, Partner with Davis Wright Tremaine. Their bios and contact information are located in your console if you would like more information. Now, I'd like to turn the floor over to Maggie to get the presentation started. Maggie.
Thank you, Danielle, and welcome everybody. Our agenda for today's webcast focuses on private foundation rules, more specifically self-dealing, which we'll discuss in detail along with taxable expenditure rules. Lastly, we'll discuss the consequences as well as corrections should these rules be violated. Okay, private foundation rules. So the federal tax law subjects private foundations to several technical requirements and restrictions, in addition to those rules that more generally apply to all 501c3 organizations. Congress legislated the difference between private foundations and public charities by the means of the Tax Reform Act of 1969. And at that time, interestingly enough, the mood of the Congress was very anti-private foundation following the years leading up to it, with the nation's legislature really being dismayed by the findings presented by the Department of Treasury in 1965 report and a series of congressional hearings. There have, of course, been some revisions, but the basic framework remains in place. So this body of law is tough and comprehensive, although over 50 years later, it's probably unnecessarily rigid and certainly hasn't kept pace with changing times. I think of new technologies and just generally our modern world. These rules include self-dealing rules, which generally prohibit business transactions between a private foundation and its disqualified persons. Minimum distribution rules, which generally require a private foundation to make a qualifying distribution on an annual basis, which is equal to 5% of its net investment assets. Excess business holding rules, which generally restrict private foundation from owning more than 20% of a closely held business. And please know that the ownership threshold is reduced by any ownership interest held by disqualified persons. And then lastly, taxable expenditure rules, which prohibit private foundation expenditures for non-charitable purpose, such as lobbying or grants to non-charitable purposes. While we've seen failures to distribute as well as excess business holding rules broken, today we're really going to focus on the self-dealing and taxable expenditure rules, as these rules seem to more easily give rise to pitfalls. However, to kick us off, our first polling question, I will turn it over to Danielle.
Thank you, Maggie. Everybody, we have our first poll. The following best describes me. A, tax professional. B, foundation representative, board member. C, attorney. D, I just want some CPE. The polling questions are located right on the slides we are presenting. So if you can't see the slides, you may need to hit F5 to refresh your console. To respond, please click the button next to the answer you choose and make sure you hit the submit button below. We'll go ahead and leave this open for another few moments. And the results. Maggie, I'll kick it back over to you.
Thank you, Danielle. Well, it looks like no attorneys, a lot of folks really seeking some CPE, interesting mix between the tax professionals and foundation representatives. And with that, I will let Marisa take us to the next section.
I know, I'm all alone here. I am an attorney, so there's one of us. There's at least one of us here. Okay, so like Maggie said, we're going to focus on the self-dealing rules. It's not because these are the only rules, but they seem to come up more often. And Maggie and I were talking before this, and it's something we're encountering more, like some inadvertent foot faults. So we thought maybe people would like a reminder. And Maggie did a great job setting the stage. Private foundations have these very rigid rules, the self-dealing rules, like foremost among them potentially. We treat private foundations differently than we treat public charities. They're all 501c3 organizations, but the private foundations have all of these additional rules on top of them because in the 60s, Congress thought they might be behaving badly. That context, I think, really is helpful as we think about these rules because they can seem a little draconian, especially the self-dealing rules. These are a strict liability regime. It doesn't matter if you didn't mean to. It can matter sometimes. Well, no, it doesn't matter. You can't evade the self-dealing rule footfall. So they can feel draconian. They can feel unfair. But they're written into the tax code and implemented through the regulations, and they've been there for decades. So we're kind of just stuck with them. So what you can do about them is understand them and make sure you can navigate them. So the self-dealing rules, these are rules that govern a private foundation's related party transactions. And when I say that, that means a transaction between a private foundation and their disqualified persons. And so a really important first step for a private foundation is understanding who are your disqualified persons, because you don't have, like, the self-dealing rules do not apply if you do not have a disqualified person involved. And there's a very specific definition of who is a disqualified person. And so that's an important thing for your private foundation to understand. So a disqualified person, it's a statutory definition, and it includes your foundation managers, meaning your directors and officers, your board members, your trustees, a substantial contributor. And this is also defined. This is not a subjective we think you gave us a lot of money thing. It's a specifically defined who's a substantial contributor, and that it's a person, and a person here means either an entity or an individual who gave more than $5,000 to the foundation if that amount was more than 2% of contributions received by the foundation from its date of creation through the end of the tax year in which the contribution was received. This is one of those things that I know how to tell you what the law is. I do not know how foundations keep track of how much money they've ever gotten in their whole life. But, I think the punchline here is like your founder, the family that created you, the company that created you, those are our typical foundation scenarios. Is you have a family that creates a foundation and funds it. Those people who found and fund you, they're disqualified persons. And that can be an individual, it can be an entity, and similarly, an owner of more than 20% of an entity that is a substantial contributor, that individual becomes a disqualified person, right? So if you have a family business that forms a foundation and that business is owned, in 3 equal parts by, siblings, then all of those siblings are substantial contributors by virtue of their ownership interest in the business. Disqualified persons include family members of people who are otherwise a disqualified person. So family members of your directors and officers, family members of your substantial contributors. And again, this is not a subjective, who do you feel like your family is? This is very specifically defined. And I think these very specific definitions are intentional. We have these very strict rules. So we similarly need very strict definitions of when do these rules apply. And so I like to joke that somebody at the IRS doesn't like their siblings because the definition of family does not include your brother and sister or your brother and sister-in-law or your nieces and nephews. But I think really why they define family so narrowly is these rules are so strict. And so who your family is for these purposes are your ancestors. It's a vertical family tree, like your parents, grandparents, and then continue with the vertical thing going the other way, your children, grandchildren, great-grandchildren, and the spouses of your children, grandchildren, and great-grandchildren, not your nieces, not your nephews, not your siblings. And it also includes an entity if that entity is more than 35% owned by disqualified persons. And so why does this matter? The starting point with the self-dealing rules, unlike the rules that apply to public charities, is that a private foundation essentially can't have a transaction with a disqualified person. This isn't, the standard is not the transaction was fair to the private foundation. It's you can't have it absent it fitting into an exception. So as soon as you have money potentially going from a private foundation to a disqualified person, you need to kind of pump the brakes, think about what's going on and figure out, is this permissible? Which means, is it in an exception? Because the general rule is the private foundation can't buy things from a disqualified person, can't sell things, can't compensate them necessarily. And so we're going to kind of walk through all of the different transactions that the federal tax law says you can't do between a private foundation and a disqualified person, and then the handful of exceptions. So the starting point, so you can't have a sale, exchange, or leasing of property between a private foundation and a disqualified person. And this goes both ways, meaning a substantial contributor to a private foundation can't lease office space to the private foundation, nor can the private foundation, if it owns a building, lease office space to them. That's just, you can't do it. There's a couple of exceptions. One, that first exception that's talking about a liquidation, a merger, a redemption. This exception is going to be relevant if you have a family foundation that's been funded with like stock, and the corporation whose stock it owns is a disqualified person. The corporation can still redeem the private foundation's stock, which might be really important. They might need to liquidate the stock to have more liquidity to meet their distribution payout. So long as it's pursuant to like a uniform corporate adjustment that's been offered to everybody on a uniform basis. Another exception is a disqualified person can lease property to a private foundation if it's without charge. And this is going to be kind of an overarching thing. If a disqualified person just wants to give things for free to a private foundation, fine. But what often comes up in the lease context is, okay, we'll let the private foundation use this office space for free, and then they're going to reimburse us for utilities. And that doesn't work unless payments go to these kind of ancillary service providers directly and not to the disqualified person. So you need to pay your utilities directly, not reimburse a pro rata share to your landlord that's a disqualified person. Similarly, lending money, we can't have a private foundation making a loan to a disqualified person or vice versa, unless the disqualified person wants to lend the money at no interest. So again, if the disqualified person is not going to get any financial upside, usually we're going to be okay. And then the other limitations on transactions between a private foundation and their related parties. The private foundation can't have any transfer to or use by or for the benefit of a disqualified person of the income or assets of a private foundation. So what do we mean by that? And this one I feel like is some of these rules are like very black and white, and you know, right? Like, you know, if a private foundation is leasing space from a landlord, right? This one's the mushy one where your spidey senses need to be really honed, because this incidental or tenuous benefit, right? Like, so examples of this is, you know, let's say I have a family foundation, its purpose is to beautify parks in the Portland area, and it's gonna undertake a really big project in Laurelhurst Park. That's great. That's furthering a charitable purpose. It can absolutely do that. And then, like, well, what if my family has a home that is adjacent to Laurelhurst Park, and so all of this work that it's doing across the street from my home obviously makes my home better. It might increase my home value. Is that permissible? And this is that question, this incidental or tenuous benefit. Is the benefit to me, a disqualified person, incidental to this charitable thing I'm doing? And so this is where a lot of the tough questions are in this space. And unfortunately, I don't have a cheat sheet for this one. Sometimes people say, oh, can you like give me a checklist? Can you know, how do I know when it's incidental or tenuous? And you know, some of these definitions are, you know, substantial contributor. It's a math test. You know, there's a right or wrong answer. This is a facts and circumstances, spidey sense, gut check test. And you're probably going to have to ask your tax professional who lives in this world. And I promise I'm not just saying that to be self-serving. It's just a tricky area. And it's you got to spend a lot of time with the rulings in this area to kind of get a sense for where you think the IRS will come out. And then finally, you can't generally provide goods or services between a private foundation and a disqualified person. Again, if a disqualified person wants to provide things free of charge, great, they can do that. A private foundation can furnish goods or services to a disqualified person on the same basis as it provides such items to the general public. So in my example, you know, if my foundation is going to maybe maintain and operate a park, that doesn't mean I don't get to go to the park anymore, right? Like, you know, but the park has to be on the same terms and conditions as everybody else going to the park. And then another really important exception, a private foundation can pay a disqualified person reasonable compensation for quote unquote personal services. So just because you have a private foundation and let's say you want to work for your foundation, that doesn't mean you have to work for free. You know, but you have to be providing personal services and the compensation has to be reasonable. And personal services, generally speaking, translate to kind of skilled services, you know, legal, accounting, investment management, programmatic things, which feels a little weird and maybe a little classist. The best explanation I can think of for why it's permissible to provide these kind of like personal services is like, I think the idea is like, if a disqualified person is going to be hired to perform the services, we want it to be because they have a special skill set to offer the foundation. And so, because if you don't, then the foundation could just as easily hire somebody else, right? So like the foundation could hire a different cleaning service, could hire a different caterer. We don't need to hire, you know, the board chair's child to do this, for example. So, but I think the key takeaway there is just because you have a foundation doesn't mean you can't doesn't mean you can't work for them because, you know, not everybody can afford to just volunteer their time and not get paid. And with that, I think I'm turning it over to Maggie to do some case studies. So we're going to give you guys a pop quiz. Make sure you were listening.
Thank you, Marisa. So our first case study, ABC Foundation needs to secure a new office space and plans to enter into a 10-year lease with a company that is wholly owned by the sister of the current board chair. As a favor to the board chair, the company is willing to offer a discount of 10% off the usual rent for the office space. Is this self-dealing? Curious what you think. So Danielle, could you please launch our next polling question?
Absolutely. Here we are with poll question number 2. Question is just as Maggie presented. Choose A for yes or B for no. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Again, please click the button next to the answer you choose and make sure you hit that submit button. We'll go ahead and leave this open for another 15 seconds or so. And the results. Maggie, I'll pass it back to you.
Thank you. Ooh, split. 55% said yes and 44% said no. No was the correct answer. For those that answered that, you were clearly listening to Marisa's slides before, because the board's chair sister is not a disqualified person in this scenario, as the family relationship is lineal, so siblings are not included in the definition of family members under the disqualified persons. Again, be cautious that you understand the origin of the private foundation when doing this, as although siblings are not disqualified persons to each other's foundations, they are disqualified persons to foundations they manage who are created or founded by their parents or grandparents. So always good to kind of trace back where things started, because in general, siblings would not be excluded, but we could have made this a tricky question as well. What if the company was owned equally by the board chair and their siblings? So in that case, the company would not be a disqualified person by virtue of being owned equally by the board chair and their 2 siblings. The entity becomes a disqualified person when more than 35% of the ownership interests are held by disqualified persons. So just the mere ownership wouldn't trigger. So the mere ownership would trigger indirect self-dealing. An indirect self-dealing is not defined, but fact patterns that cause particular concern include transactions between disqualified persons and an entity controlled by a private foundation, as well as transactions between 2 disqualified persons that affect private foundation assets. One reminder, and it's a bit of a riddle, is you could do anything indirectly that you can do directly, and as far as these self-dealing rules are concerned. However, you cannot do anything indirectly that you cannot do directly. So with that, I will turn it back over to Marisa.
Thanks, Maggie. All right, so another case study. I don't think we have a pop quiz on this one. So ABC Foundation furthers its charitable purposes by operating an art museum that's open to the general public. The founder and primary funder of the foundation plans to visit with their family, which will require them to pay admission. While there, they visit a recently opened gallery, and it's named after the founder, and their name is prominently displayed. Do we have self-dealing? So no. So this is kind of like the park example that I gave earlier, that, even though, right, we have a disqualified person, right, they founded the company or the substantial contributor. So that means the founder, they're a disqualified person, and then all of their progeny are too. And so they're visiting the museum on the same basis as the general public. So there's not an active self-dealing for that visit. Similarly, the name being up there, it's interesting, and the Treasury regulations specifically address this, that kind of the halo effect from doing philanthropic things is not considered an impermissible benefit. It's deemed incidental and tenuous. So back in that kind of gray, mushy, spidey sense area that we're often dealing in. So that's why donors can give money to charity and in exchange get their name on a building, and it doesn't offset your deduction. And, all these family foundations can be named after the company that founds them and the founder and the family, and it's not a problem. So it's an interesting, if you're willing to give your money away and do good things, the IRS says you get to get the public recognition for that, and that benefit is incidental and tenuous. But again, in the self-dealing rules, the facts and circumstances really matter. So, I mean, this might be a very obvious one. Like, what if the founder, while they were at the museum, right, this is my foundation, it made this museum, we've got this like storage closet, it's got all these paintings in it, and they're not up, right? They're not doing anybody any good there. So I'll just take one of these painting homes and put it up in the house because it's not going to be rotated into the gallery for like 6 months. Like, would we have self-dealing there? And the answer there is like, absolutely. That's taking a foundation asset and using it personally. So again, with I think the takeaways here are, know who your disqualified persons are, understand when foundation, charitable, tax subsidized assets are being used by them. And if that's happening, you need to figure out, okay, what exception are we into the self-dealing rules? Otherwise, we might have a problem. Maggie, I think you get to walk us through the taxable expenditure rules.
Yes. And before we get there, just to close out self-dealing a little bit, just wanted to circle back to my comment about, today's modern world and how much has changed over the last 55 plus years since these rules were enacted. And just things to pay attention to, right? It's much more easy now to make a transaction instantaneously on your iPhone, whether it's a Lyft or Uber ride and you're paying with the wrong account or Venmo. So making sure that your foundation, thinks about those things, protects, the board members, disqualified persons, and put some safeguards so you don't end up, making a silly mistake that ends up being a taxable event. Because as Marisa said, there is no abatement for self-dealing. And with that, we'll turn over to taxable expenditure rules. So all 501c organizations, so that's both public charities and private foundations, are prohibited from engaging in any political campaign activity. However, public charities can engage in an insubstantial amount of lobbying. And while most private foundations, I would say, are well aware of these rules and don't engage in these types of activities themselves directly, may run afoul of these lobbying prohibitions if the grantee engages in lobbying. Therefore, navigating these rules, the private foundation should ensure that it's not earmarking the grant for lobbying, and if it is a project grant, that the non-lobbying budget for the project exceeds the foundation's grant funding for that project. So what I mean here is, if you have an organization that has a $50,000 budget and does some lobbying, and if you're given $50,000, that implies that part of your funding would go towards lobbying. So that's what that last piece was trying to demonstrate that. As far as the grant making is concerned, a taxable expenditure includes a grant to an individual for travel, study, or other similar purposes, unless it's awarded pursuant to the IRS approved objective and non-discriminatory procedures. And that's either done at the time of the exemption application, so your Form 1023 at the inception of your private foundation, or it can also be done later as a separate request, and that's via Form 8940. The approval is not for a particular grant program or programs, but instead it's a one-time approval of a system of standards or procedures and follow-up designed to result in grants which meet the regulatory requirements. So the IRS wants to ensure that you're selecting individuals based on non-discriminatory and objective basis, that the program is publicized, so there's a pool of applicants, that you have a selection committee, and all the other processes in place. And so, of course, there we go. And of course, a grant to an organization other than a qualified public charity, unless the private foundation exercises expenditure responsibility. An expenditure responsibility requires due diligence on a potential grantee a written agreement containing specific provisions required by the tax law, full and completing reporting by the grantee on how the funds are spent, and reporting to the IRS, of course, regarding the expenditures, which is done via the annual filing of the 99D PF form. And then I will turn it over to Marisa for our first case study in this section.
Okay, so ABC Foundation awards a grant to a public charity, and that public charity grantee uses some of the funds to engage in lobbying. Do we have a taxable expenditure? I think this takes us to our next poll.
All right, poll number 3. ABC Foundation awards a grant to a public charity. The public charity grantee uses some of the funds to engage in lobbying. Would that be considered a taxable expenditure? A, yes. B, no. C, maybe. Also, you do have the option to submit questions in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. We'll go ahead and keep this poll open for another 15 to 20 seconds to allow a few more responses. And the results. Marisa, I'll pass it back to you.
Great. And this was it was kind of a trick question. So I am, good job, everybody. I think, yeah, it could be, it might not be, maybe. So I think they're all right in this situation. So it depends. That's a lawyerly wishy-washy answer. So apologies, because I know it's unsatisfying. But this is an area where, facts and circumstances really matter. And so a private foundation can make a general support grant to a public charity. And generally the grantee's use of those grant funds for lobbying isn't going to be traced back to the source of the funds, so long as it wasn't earmarked for lobbying. When we talk about earmarking, what we mean is, was there an agreement, oral or written down, that the private foundation could kind of require the grantee to use it for those purposes? If so, we would have a problem. So a private foundation couldn't make a grant to a public charity and say, hey, use this to go lobby. That doesn't work. But if a private foundation makes a grant to a public charity and that public charity chooses to use it to go lobbying of its own accord, that's fine. That's not traced back. And when we say general support grant, this isn't really defined. And so one of my pet peeves is when people say, I'm making a general support grant to you, public charity, for this program. It's I don't really think that's a general support grant. General support grant is I'm giving you the check and you do what you want with it, grantee. I think I could say, as a private foundation, you, grantee, only use this for your charitable purposes. That's fine. That's a typical limitation for both the grantor and the grantee. The safe way to do this is give them the money and don't tell them they have to use it for anything in particular. And then if the grantee chooses to go use that for lobbying, that's on them. It's not on you as the funder. If you do a project grant, and so you have said, okay, grantee, you can have this grant funding, but you have to use it for a particular education program, that's fine, even if that education program involves lobbying, so long as the non-lobbying portion of the budget exceeds the amount of the grant. So it's kind of let's say, these are not realistic numbers, but I don't want to have to do hard math in front of you on the fly. Let's say the project is going to be $1,000. You've given a $500 grant. So long as at least $500 of this project is not lobbying, you're going to be okay. Because the idea here is all of the foundation's money can be allocated to the non-lobbying portion, and it can absorb that. And this obviously leads to some kind of silly results. Well, what if the entire project is funded by two foundations or three foundations? Obviously some foundations' money is going to the lobbying portion, and that's okay. That's what the rule says. As long as you as the funder are responsible for your portion, and if the non-lobbying budget can absorb your dollars, you don't have a problem. All right, next case study.
And Marisa, I'm just curious, because we often see that in the grant agreements for private foundations, but there's a clause for not using the funds to lobby. Is that what you would generally recommend? Is that really like a foolproof protection, or is that just, just curious?
Yeah, it's gonna be, oftentimes grant agreements are more restrictive than they need to be, right? It's like private foundations know I'm not supposed to lobby, so I'm going to tell you you can't lobby, and you don't need to do that again. If this is a general support grant, and you can only make a general support grant to a public charity, from a tax compliance perspective, you can just send the check. The fact that your grantee has a 501c3 status and it's a public charity, that is a proxy for those funds will be used charitably. So you don't even need a grant agreement. You might want a grant agreement for other reasons, but you don't need it. And you don't need to say you can't use it for lobbying. On a project grant, if you think there's a lobbying component, I generally recommend relying on the language in the Treasury regulations that says, you grantee are going to use it for this project, and you've represented to me that the non-lobbying portion of this budget is more than my grant. But no, you don't. You as the funder, if you're funding public charities, don't need to tell them they can't lobby. If you're doing an expenditure responsibility grant, meaning a grant to a non-public charity, you do need to include language in there that says don't use this for lobbying. All right, another case study. If ABC Foundation makes a grant to a public charity serving as a fiscal sponsor, and then it re-grants the funds to the person conducting the project, who does the IRS view as the grantee in this situation? And this, as you guys might guess, is another it depends. And fiscal sponsorships are tricky. So we kind of wanted to make sure we got a slide in there about fiscal sponsorships. Fiscal sponsorship is not a legally defined term. It's not defined in the tax code. I've never found a state that defines it in state law. So it's this umbrella term about that we all kind of generally understand what it means, but it's not just one legal relationship. It's an umbrella term, and it refers to ways in which an existing 501c3 organization makes its 501c3 status available to raise funds for either another entity or another project. At a high level, sometimes you have a direct project model fiscal sponsorship, and that involves the fiscal sponsor kind of taking the project on as its own activities. So that means like the people that are doing the legwork, maybe you hire them as employees or independent contractors. And so the money goes into the fiscal sponsor, and then they allocate it to this program that they're now operating. Or you have a re-grant model fiscal sponsorship where the money goes into the fiscal sponsor and then gets re-grounded out to a separate entity. And so it's this interesting needle to thread that this is permissible. You know, there's ways to do fiscal sponsorship properly. We've been doing this for decades. But there's like some tension in this idea about earmarking we were talking about. So it's like, how if I'm a private foundation funder and I've given money to a fiscal sponsor and I can't earmark it because you've told me that if I tell the grantee that they have to give it to somebody else, that, you know, I've earmarked it and it's treated as a grant for me to the like second grantee, but we have fiscal sponsorships, and it's weird. And so a fiscal sponsorship done properly is that the difference here is the public charity, before getting this grant from a private foundation, has entered into a fiscal sponsorship with the fiscally sponsored project or entity, and the public charity that is doing the fiscal sponsorship has decided it wants to support that, and it's the fiscal sponsor that enters into the agreement with the private foundation funder. So this is a challenging area and it's confusing, but just kind of wanted to touch on how a fiscal sponsorship should work. Is you want the fiscal sponsor to have discretion and control over the funds that it is using for the sponsored project or entity, and the fiscal sponsor should be entering into the agreement with the foundation, even if it's known and even if the agreement itself is contemplating, like, I'm giving money to you, fiscal sponsor, for this fiscally sponsored thing you are doing.
Okay.
Maggie, you want to tackle scholarships?
I will tackle scholarships, and this comes up a lot. At least I see it a lot in practice. A lot of private foundations want to give out scholarship grants. So ABC Foundation makes a grant to an individual for travel, study, or similar purposes in the form of a scholarship or fellowship at an educational institution. is that a taxable expenditure? And again, we're going to quiz the audience here. Danielle, can you please pull up the next polling question?
All right, everybody, here's your chance to respond to Maggie's question for our final poll. Is it A, yes, B, no, C, maybe? For those of you that would like a copy of today's slides, you can download them now from the console. We will also be sending them out via email tomorrow, along with a recording of the webcast. We'll go ahead and keep this slide up for another 20 seconds or so to get a few more respondents. And we're going to forward on to the results. Maggie?
Thank you. Split across the board. And again, probably like the last questions, there's really not necessarily a wrong answer because, of course, it depends. Does the ABC Foundation have IRS approved scholarship procedures, right? So if they did, that would be permissible because it would be awarded on an objective and undiscriminatory basis that was approved by the IRS. And as I mentioned, there's two ways to do that. One is for new foundations via the Form 1023 application for the tax exemption, or if you decide to do it later, Form 8940, the miscellaneous determinations, allows you to seek that approval as well. But what if ABC Foundation provided funding to an intermediary public charity that then distributed the scholarship funding? Does the IRS view this as a grant to the fiscal sponsor or the sponsored project? So it also depends. Really, as long as the grant is not earmarked for a named individual and there's no oral or written arrangement where the ABC Foundation can designate that specific individual recipient, such a grant to a public charity then that makes the grant to the individual would not be attributed to the private foundation. So, a private foundation couldn't say, go to, let's say you're giving a grant to another public charity or even a university for scholarship. You couldn't say, I want to give this one to Maggie Elliott. You would have to just give them the funds and let their processes, which are for selection, be taken, independently, and them awarding an individual with the foundation not having any involvement in that process. So the public charity must really control the selection process in that case. And with that, I will turn it over to Marisa to get us started on the consequences and correction.
Okay, so we told you all these things you're not supposed to do. We haven't really told you why. Like, okay, what if we mess this up? So the private foundation rules, and like all the private foundation rules, they're enforced through penalty excise taxes. So if you run afoul of them, you're going to trigger a first-year penalty excise tax, which is a hand slap, right? And depending on how big of the mess up will depend on how big and how painful that hand slap is. But for self-dealing, it's an initial tax of 10% of the amount involved. So not great, again, depending on what's happened. But the thing is, you have to correct it. Otherwise, there's an additional 200% tax imposed for the failure to correct. So, if somebody was thinking, oh, okay, well, this is a bummer, but this is just going to be an additional cost of doing business. Like I'm going to, I'm just going to pay the landlord anyway, and we'll just pay this 10% on top of what our lease is, and that's going to be fine. It's not fine because it's going to, you have to correct it, and then if you don't, it's going to be 200%. Similar with taxable expenditures, there's an initial tax of 20%, and then if you don't correct it within the correction period, there's an additional 100% tax imposed. And we'll get into some more of the details, but the overarching structure here is there's a penalty for messing it up. You need to correct it, and if you don't correct it, there's a much bigger penalty that comes into play. So that, again, a private foundation can't just choose to run afoul of these rules and treat it as an additional cost of doing business. And another interesting point is, depending on which rule we have a problem with is going to depend on affects like which person has to pay it. So in the self-dealing world, the penalties on the disqualified person. And so this can be very uncomfortable. If you think you have, let's say back to our landlord example, the private foundation's been renting space. It all of a sudden learns like, oh my goodness, we couldn't be paying the utilities directly to our company that founded us. We have a self-dealing transaction. You got to go to the disqualified person and say, hey, we have a problem. We need you to give that money back. And we also need you to file this tax form and pay a penalty. So it's very unpleasant, depending on the situation, like it's not great, right? It's not good. It's uncomfortable. Where this can be helpful is if you're in a position of enforcing compliance and you're going to, this can be very uncomfortable, right? You have a founder that maybe wants to do something like, oh, no, the private foundation, it can definitely rent office space from me. I'll give you a 50% discount. It'll be fine. Like, it's not going to be fine. That's going to be a self-dealing transaction. And you can frame it as, we can't do this because we need to protect you, disqualified person. So in some ways this can be helpful as a way to say, like, I'm sorry to be a wet blanket, but really it's not that we, the foundation staff and program officers, are wet blankets. It's that we're worried about you, disqualified person. But if you do have a self-dealing transaction, it can be uncomfortable to let people know that there's a problem and we need our money back. Generally, these penalty excise taxes aren't going to be on management. They can in certain circumstances, but it's a knowing, it's a knowledge issue. So if you inadvertently run afoul of these, that's usually not going to then attach liability to your directors and officers. And there's a disclosure process. You have to disclose that this happened on the IRS Form 990-PF, and then that will likely then involve filing also a 4720, which is where like the specifics of the transaction are involved, and like the tax is paid, or the tax might be paid with your private foundation's 4720. And self-dealing is going to be that the disqualified person has to file 4720 and pay the tax. And another important point on this, like filing the return, I think in a lot of these situations you want to like put your head in the sand and pretend it didn't happen. But in order to get the statute of limitations running on these things, you have to adequately disclose them on your Form 990. So yeah, and then we have a little bit of time left, and I'm going to turn it over to Maggie, because like you get like there's a lot of details about like, all right, what's the amount involved and what's the correction period, and this is where accountants are generally just much better at this.
And generally we like to, if you saw the slide on all the self-dealing taxable expenditure and all the other items from the section we discussed earlier, the excess business holdings, and the chart that demonstrates the penalties on the initial penalties, the second tier penalties, potential penalties on the management, and those that were aware. The chart is a lot, and it really demonstrates, I think it often scares a lot of people because it's not insubstantial. And as Marisa alluded, if the amounts are large, it really could quickly add up to quite a bit of dollars. So the amount involved does depend on the act, and the excise tax imposed on the disqualified person or foundation manager depends on the type of the transaction. So for most of the self-dealing acts, it's the amount paid or received or the fair market value. In case of compensation, especially if it's just excessive compensation, it would just be the excess if it was deemed not reasonable. And then the other one on the list that I wanted to highlight here is the loan. It's both the principal amount, but also any interest that may have been charged or should have been charged if the funds were loaned to a disqualified person. So if there was, an inadvertent loan, not only would the funds need to be returned, but we advise our clients to also, calculate an interest, right? If the foundation if it was, over a course of 6, 7, 8 months, right? Typically those things are not discovered till we're doing the tax work, for example, which is well after the fact, that you calculate and consider that time period. And if the foundation were to take those funds, for example, and invest them or put them in a money market, what would that interest be, and sort of to put them back in the place that they would have been had this not happened in the first place. And I will flip it back over to Marisa for the correction.
Yeah, and I see we had some questions about corrections, like, you know, we have a taxable expenditure, it's related to a grant, like how do we even get that money back? And so, yeah, the correction, the general idea is, you know, place the foundation with self-dealing, put the foundation in as good of a financial position as it would have been had it not occurred, and a taxable expenditure, recover the expenditure to the extent possible. Sometimes it is not possible, right? Like, let's say you awarded scholarships and it turns out you didn't have pre-approved grant procedures in place, so those are technically taxable expenditures. Are you really going to go claw back scholarships from students? No, I do not. I would never advise that. I don't expect you to do that. So correction is, you know, get the money back where you can. If you can't, document why you didn't, why you can't, why is this not a realistic thing for you to do? And then put policies and procedures in place that safeguard against future mishaps. Like, that's another piece of this. Like, okay, we realize we messed up. We've documented why we can't go get money back from students because that's abhorrent and we're not going to do that. But we have now applied to the IRS to get our scholarship procedures approved in advance, and we've done an internal training so that the program officers now know we have scholarship procedures that have been pre-approved, and this is how we have to award our individual grants moving forward. And so that's how you correct in those circumstances. Sometimes it's just not going to be realistic to get the money back. Maggie, I think you're up on abatement.
Thank you. So if a taxable event is due to reasonable cause and not willful neglect, and correction occurs within the applicable correction period, you may seek abatement of the first tier excise taxes. This is not applicable to self-dealing excise taxes. I think we mentioned that a couple of times earlier. And because for those, each year the transaction goes uncorrected, an additional penalty for a new act. So it's still the same act, but each year it's a new act. So if you mess up in 2024 and don't correct it, it's another taxable event in 2025, and continues on and on. So that's why the correction is important, and it's important to identify these things, sooner rather than later, than finding out that there's multiple years, multiple acts, and a lot of work to kind of undo it all. In the technical advice memorandum reference here, IRS has determined that the first tier excise taxes due to undistributed income for the years at issue shouldn't be abated because the trust failed to establish that it acted with reasonable cause and not willful neglect. And what this trust did in an attempt to correct a taxable event after multiple years of not meeting the required minimum distribution payout, it made charitable expenditures before the end of its, I believe it was fourth tax year, to meet that year's minimum distribution requirement. It filed the 4720 requesting abatement and actually approval of a set aside to cover the undistributed investment income from the prior years. It tried to demonstrate that the board and staff worked on expanding its programming. It recognized the liability on its book and worked with tax professionals on the minimum distribution requirement for future years. The trust also, I think, claimed that it relied on the accountants involved to advise the trust that it was a private operating foundation, not just a grant-making foundation. But the foundation never went back to try to correct those prior period returns, to correct the distribution reporting. And what I mean here is, if they were truly following the advice and trying to be a private operating foundation, which you could switch from a grant making to operating foundation on your return without any IRS approval ahead of time, it would be a different section of the 990 PF that would need to be completed here. So they didn't make an effort to do that. And then it ultimately turned out that they actually did not meet the statutory requirements for a private operating foundation in the first place. So a lot of faults there. And it's in cases where it's clear that they're just trying to kind of backstep and didn't really make the effort upon discovery of the issue. I think that's this makes sense why they were denied the reasonable cause. And then just to close this out, I know we only have 5 minutes left, but we have a few case studies to go through for the consequences and correction section. So ABC Foundation founder personally owns a building in which there's a vacant office that he allows the ABC Foundation to use, charging minimal below market rent to the ABC Foundation. So of course, hopefully everyone knows now that ABC Foundation paying rent to a disqualified person is in fact an act of self-dealing, even if it's below market rent, even if it was a $1 rent being charged. Unfortunately, there is no de minimis, so even $1 would be breaking the act of self-dealing. The founder must repay the amounts paid by the ABC Foundation and report the act of self-dealing on the IRS Form 4720. And that's Part 2 and Schedule A, paying the excise tax liability. The ABC Foundation must also file the IRS Form 4720, completing Part 2 to report the excise tax liability. But the key here is the ABC Foundation cannot pay that penalty excise tax. That would be another act of self-dealing. And what's interesting is before or in the past, the Form 4720 kind of included both pieces. They split up the form several years ago where, as demonstrated here, the individual files or the entity files 14720 and is supposed to pay the tax. The foundation files 4720 just to acknowledge that it happened. They're not obviously liable for the tax. In practice with the IRS, this has proven very challenging. I'm actually working on with a client now to try to resolve seriously this exact issue. And what ended up happening is that the 4720 that was filed by the entity that paid the taxes had some penalties and filing penalties for the 4720. And what the IRS did is they took those funds from the foundation. So without the foundation even doing anything, essentially the IRS put them in another act of self-dealing. So even they don't really maneuver these rules. And, sometimes it's in cases where you're trying to be forthcoming and do the right thing, it could even cause more issues. And then the last piece here, so the ABC Foundation makes a grant to a private operating foundation without exercising expenditure responsibility. So a private foundation making a grant to a non-public charity without exercising expenditure responsibility would be a taxable expenditure. Operating foundations do have some different qualities, but they are still private foundations at the essence and subject to all the same tax laws. So in this case, on the Form 990-PF, the Part 6B, Question 5A4 would be answered yes. And if the foundation is unable to recoup the funds from the grantee, as Marisa alluded, in cases of scholarships, right, you're not going to go after the students. In case of grants, it's sort of similar. Oftentimes in practice, the foundation is just not going to go and try to claw back the funds and get a refund. So in these cases, the directors and officers or funders or founders of the foundation may correct the taxable expenditure by just depositing the funds to correct the act. The Form 4720 Part 1 and Schedule E would have to be filed by the ABC Foundation, and they would pay the penalty taxes. And with that, I will turn it over to Danielle to close this out. Thank you.
Fantastic. Thank you to both of our presenters for a great presentation today. To our audience, if you have any further questions or comments, please reach out to us as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to the presenters directly. Their contact information is in your console as well as in the slide deck. You can download now from the handouts window. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. Finally, here's a link to the survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.